Jackie, you're on a bit of a crusade to improve transparency in investment trusts. Are you winning this battle? And why is transparency so important for investors?
For us, transparency is critical. If you're going to give your money to a fund manager to manage, I think you have the right to know what it is they're doing with that money. And transparency helps build confidence as well. And for us, it's less about getting data right at the month end on a regular basis. It's more about having it in a format that advisors can use. We need to empower the advisors to be able to make informed assessments of their client portfolios and really understand the risks that they're exposed to. And they can only do that if the data's coming into a central place and having standard categorisation applied to it, so that when you're looking at a company, you know that you're looking at everything on the same playing field. 3 years ago, we had no data for investment trusts in this format. Today, we have 127 funds who are reporting at least half-yearly full portfolios. That's pretty good progress. We have some way to go, but we're very encouraged.
What effect do you think the retail distribution review will have on investment trusts?
I think RDR is having an effect already, to be honest. There's a lot more talk about investment trusts, there's a lot more advisors asking questions. We're seeing quite a bit of uptake at our events. I know the AIC are getting a lot of people come to theirs. We're seeing a lot more questions come through on the monthly webinars that we're doing. So people are definitely asking questions now, and investments are coming to the fore of people's minds. And of course, let's not forget, from next year, if an advisor wants to call themselves independent, they need to be able to advise on whole of market. That includes investment trusts and ETFs. We've been really championing the education of investment trusts for the last 2 years, and we're going to carry on doing so.
What advantages do investment trusts have over open-ended funds, and do they outperform open-ended funds over the long term?
Investment trusts have some structural advantages. So, for example, they can use gearing. They can borrow a bit of money, invest it when the markets are rising. That can be very helpful. Another advantage is they can trade at a discount to their net asset value. So you pay less as a shareholder for the asset's worth, and you can get the benefit of that discount narrowing as well. They have revenue reserves. So to explain by way of an example, Foreign and Colonial Investment Trust, the first investment trust, has just recently announced, an increase in its dividend of a record amount. Every year since 1970, they've increased that dividend. As a shareholder, you have comfort knowing your income payments are going to go through. Have they outperformed? We tend to look at them relative to their peer groups. Again, it links back to categorisation and why we need that data and transparency, because we want to make sure that we're looking at funds really against their true peers. So not just investment trusts, but open-ended funds, exchange-traded funds as well. In most cases, yes, they do outperform over the long run, but to be honest, we would expect that because of the structural benefits, and also things like the fact that they are a closed asset base, so managers can run them in exactly the way they want to. They're not having to deal with inflows and outflows as market trends change.
Could you give me a few examples of some investment trusts that are rated highly by Morningstar?
Sure. I think first off, it's important to stress that we're still building out our coverage. So there are some very good funds out there that we haven't rated yet. If I was to pick up on a couple, first of all, I'd cite Murray International, run by Bruce Stout. He's been involved with the fund for well over 20 years. He was there as Murray Johnston before Aberdeen acquired them. Very dependable, rising income every year. They make use of the revenue reserves when they need to. As a shareholder, you know you will get your dividends, but actually you've had capital growth too. Something to watch out for on that fund though is it is trading at a premium at the moment. I think that's a reflection of the fact people are prepared to pay for income at the minute because yields are so low. That actually it's quite nice having that certainty, but we would just caveat that a little bit. Another example is Baillie Gifford Japan, where it's been notoriously difficult to make money in Japan, but actually they've done so there, and they've used gearing in the fund well. So it shows that managers can use these structural advantages for the benefit of shareholders, and actually produce some pretty good returns in difficult times.
Thank you very much for your time today, Jackie.
Thank you.